Guys, welcome back to the channel. Today's video, we're going to be looking at 5 basic ways to grow your money. Now, overall, with inflation going up, CPI going up, a lot of other indicators that are still kind of steady or declining slowly, the only thing that is not going to save your money, and this is one of the common myths, guys, is cash. If you have cash, if you have $100 today in your hand, if you have $100 tomorrow, chances are the borrowing power or the buying power of that currency is going to go down over time. Even when you look at increases in stock market, when you look at returns that you can get right now, because of the Fed's fund rate being at 5%, which could possibly go higher. Again, over time, that money does not have the same value that it will have today. So if you're sitting on cash for days, weeks, months, even years, under the mentality of cash is king, that is not really true anymore, guys. Because of the rising inflation, you are going to be losing cash. But the question is, how can you grow that cash and grow it into more cash? First one, of course, savings accounts. We've talked about this before, guys. When it comes to high yield savings accounts, there are places that are paying 3, 4, even 5% if you have found them on savings accounts. You're talking liquid assets where you should have your emergency fund, where you should have your 3 to 6 months of savings. It is very imperative, guys, that you get a return and you get a decent return. Anything that you're getting in return, so let's say you're at 4%, inflation's at 5%, you're only losing essentially 1%, where again, if you did have that currency in cash, you would be losing that full 5% of inflation because the money is not working for you. Now, long term, this is going to be the game changer, guys. When you start factoring in growth factors, when you start factoring in compounding interest, when you start looking at all of the things that you can get from the investment portfolios that we kind of build and develop and work on, you can exponentially grow your money much higher than it is today. Now, the second one that we look at is CDs. Now, again, similar to those high yield savings accounts, there are a couple institutions that are offering 4 or 5% CDs. Now, question I get a lot is right now, short-term money is very expensive, where long-term money is not as expensive. So if you look at some of the 12 or 23-month CDs, they're yielding a higher rate than some of your 5-year terms, which means having short-term money could be beneficial in the 9-month, the 12-month, the 23-month, 24-month, regardless of what the CD term is, it could be beneficial to go for a shorter term. However, this is kind of the deciding point or the clarity point. If you look at some of the rates, it's not so much what the rate is today that you're getting for those products in 12 and 24 months. It's what do you anticipate those rates to look like in 12 or 24 months when that does come due. So currently, if you're doing a 12-month CD, and let's say that 12-month CD is at 5%, in 12 months, let's say the rates are now 2%, now you're going to have to scramble. Savings accounts and CDs will not be an option because the Fed has lowered interest rates, meaning that a lot of those high rates that we're seeing right now on savings accounts, I know we're seeing it on anything that you're looking to buy, but a lot of the rates that we're seeing on savings accounts and CDs will essentially be gone. We have already started seeing a couple institutions start bringing down the longer term rates, and next will be the shorter term rates that are going to start with those CDs. So this is the reason why a lot of people are kind of going out a longer term. I've seen a lot of people doing 5-year CDs at 5%, which at 5 years, the chances of the rate still being at 5% in 5 years, if I had a crystal ball, that would be absolutely amazing. But they're under the anticipation this is money they're not using in the next 5 years. If you can grow it at 5%, especially if those inflation rates start coming down and the Fed's fund rate starts coming down, those 5% rates on those CDs are going to be gone. Now, next one we look at is bonds. Bonds have a little bit less liquidity than we see with CDs and savings accounts, where all you have to do is pay a penalty. Now, you can buy corporate bonds, you can buy government bonds. A lot of people even bought I bonds. We've seen EE bonds. Now, government bonds do have their own set of rules. I know a ton of people who went in there, bought those I bonds because the rate was high, and now the rate has continued to lower. I believe it is every quarter. The rate has been lowering, and I believe the next rate lower is going to be, I think it was 4.6, 4.8%. Great when the bond was paying 8%. Now your rate is literally cut in half in less than 6 months, which means, again, you're not going to be getting that great rate, and you still have to hold the I bond. That is one of the caveats. If you did not do your research, guys, you do have to hold on to that bond for a considerable amount of time before you can cash it in. And then when you do the interest earned, of course, you do have to pay interest on. because the government wants their money out of there as well. Plus, if you went through Treasury Direct, it was a little bit more difficult than a lot of people anticipated to set up an account and actually get the bonds, to hold them for, I believe, 1.5 years is what you have to, after 1.5 years just to sell them back to make a little bit of money. Because remember, it was capped at 10,000 you could put in there, and I believe it was 10,000 out of your tax return. So you could buy some I bonds. Again, if you were holding them, great. That was amazing rate, but now that rate is slowly going away. Next one we look at is the stock market, guys. Now, personally, this is my best and biggest advice. I'm not a financial advisor. I'm not a tax advisor. But guys, when you look at some articles, there was actually an article earlier on CNBC. It says when you look at the S&P 500, so when you look at the Vanguard, the VOO, the Vanguard S&P 500, it said 81%. Now think about that, guys. 81% of financial advisors cannot beat the return in the S&P 500. Now, with that being said, the reason for this is the fees that they charge. And again, this is a lot of research. If you literally Google the article, they said 81% of financial advisors cannot beat the return on the S&P 500 because of the fees that are associated with the accounts. Now, if you're like me and you use M1 Finance, which there is a link down below, it has zero commission fee trading, which means that you're not paying that 1%. So most financial advisors have a monthly maintenance fee, possibly an annual maintenance fee, and usually a 1% service fee when you do when you have their advising services. And there can also be additional fees, guys, which of course are going to eat into all of your earnings. If you look at 5, 10, 15, even 20 years, if you're paying 1% of your return over 20 years, chances are the S&P 500 fund will be far superior when it comes to the return. Last one we look at, guys, is mutual funds. This is one that I'm not super familiar with. I like doing the ETFs. They are really my bread and butter. But mutual funds, a lot of people do really advise the mutual funds. And I bring this up because I know Dave Ramsey says mutual funds. That is really what he said. I'm going into a couple different categories, having some, a growth mutual fund, having a couple different mutual funds within a portfolio. Overall, again, when you look at the return, even looking back over the last 10 years, the stock market has yielded good returns over time. That is one of the big things, guys, is when it comes to the return in the stock market, you are looking at over time, you are looking at a considerable amount of time, because even if we have 1 or 2 down years like we've seen in 2022, having a solid down year, 2023 has been rebounding, and we expect it to continue for pretty much the majority of this year. Even going into 24, as soon as the Fed starts lowering interest rates, you're going to see the stock market really taking off and really excelling from there, guys. All right, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.